Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson here, certified financial planner, practitioner with Big Al Clopine. He's a CPA, certified public accountant.
Yeah, that's what that stands for. In case you want.
You have to say practitioner after CPA?
No.
I wonder, I think I'm
Certified public accountant.
certified financial planner, practitioner.
You're supposed to say practitioner?
I don't know. I
just
thought
do.
I read that somewhere. But
Oh, yeah. No, I've never heard that for an accountant.
probably I'm in the danger zone and for compliant reasons.
We know. We get a memo every week, don't we? Guys, you can't really say that. Okay.
Okay.
All right. We'll be more careful.
This is my favorite part of the show, folks. We've been doing this the last couple of weeks, and I got the email bag, Alan. Investopedia is all over me.
Okay, they are.
They are.
Hey, I even got the list this time. 9 questions.
Well, you can't see the questions.
I can. They're right in front of me.
Who gave them the questions? Son of a gun.
I have sources.
So, all right. Here, give me that list.
You mean I don't get to see them? Oh, geez. So I'm going off the cuff
Yeah,
again.
we got to go off the cuff. All right.
Wow.
I remember last week. It's like, what happens when you have a high margin product and no profits? Get new management.
That's what I said. I listened to the podcast last week.
That's Big Al.
Great stuff.
All right, so Investopedia, they send me these questions each week.
Okay.
And I mean, why we? Because they're good questions. Well, some of them are. Some of them are awful. No offense, Investopedia. But
All right. What do you got for me?
But the point of this exercise is that I'm sure a lot of you have the same questions as these people have.
Sure.
And so we can answer these questions, and you're like, oh, well, that applies to me.
That fits.
Fit did.
And,
All right.
And even if it doesn't fit, it's interesting.
Here we go. Here's one. This is right up your alley there, Big Al.
Okay.
Let's see. This individual's asking if they qualify for a capital gains exclusion.
Okay.
All right. So here's the email.
All right.
I have 2 townhome units, 9 and 10.
Okay.
I lived in number 10 since 2006 and rented number 9.
Okay.
I want to sell both and buy a new larger home using capital gains.
Okay.
I will have approximately $200,000 from number 10 and $150,000 from number 9 in capital gains.
Okay.
The new home will cost approximately $500,000. If I use these gains as a down payment for a new home, do I qualify for a capital gain exclusion under Taxpayer Relief Act of 1997?
Wow. Going way back. I like that. Well, let me answer that question.
Well, the Tax Relief Act of 1997 he doesn't know about the 121 exclusion?
No, that's when it came about.
It's 1997.
Yeah, I believe.
So that's the 121 exclusion is under the Tax Relief Act of 1997.
I believe so. Yeah, don't quote me 100%, but that's what I believe.
All right.
Anyway, so what he's referring to is when you sell your residence and you've lived in it at least 2 out of the last 5 years and you're single, you get a $250,000 gain exclusion. So that means the first $250,000 of capital gain is as if it didn't happen. And if you're married, it's $500,000 gain exclusion.
So, all right. So he lived in number 10.
Yeah, number 10. So that's
number 10 is $200,000. So he's good.
$200,000 capital gain there, no problem. Okay, the rental, big problem. He's got a $150,000 gain in the rental. That's fully taxable at capital gain rates. I don't care what you do with the money. It's fully taxable. Now, he could do a 1031 exchange on number 9 and buy another rental, but that has to be rental for rental. It can't be rental for residence. So there's really no way to roll a gain from a rental into a principal residence.
So here's what he should do. You should then buy the bigger home, 1031 exchange number 9
yes,
into the home, rent his home out for a couple years, and then move into it.
I like your thinking. Yeah, one step ahead of me, because you can do that. So here's the rule. So you can sell number 9. You can buy a home that you eventually want to move into, but it has to be a rental at the time that you buy it. And you ought to rent it for a while. I think most accountants would say a couple years might do it, but really it's not so much the time frame, it's the intent when you actually bought it. So if I have any IRS agents listening, just be careful, because if you do intend to make that your residence, you could be challenged because you didn't have the right intent when you bought it. However, needless to say, people are doing that. They're selling a rental, they're buying a rental, which is a nicer place. They 1031 the exchange into that. He can sell his residence, and there's no gain on that, so he can use that down payment to pay for this other residence. And then you rent that out for a while, and later on you change your mind. Now it's, you know what, now I think I want to live in it. Let's not have that be a rental anymore. And that actually does work.
So the 121 exclusion, $250,000 if you're single, $500,000 if you're married.
Yeah,
you got to live in the house too in the last 5 years.
And by the way, because I get this question all the time, both spouses have to own the home for 2 years and live in the home for 2 years. I get the question, well, what if I get married the day before I sell? And like your spouse has never owned it or never lived in it. Doesn't work. Your spouse has to live in it 2 years and be 2 years of ownership.
How about if I get divorced? 12/30.
Okay.
And I write.
Then,
let's say I sell it at 12/31, and I get divorced a couple of days before that, so I'm not married. So
that's there. It depends upon how you title the property. So if the titling is kept in both husband and wife, they would each get the even though they're divorced,
each?
they get the $250 each, because now it's a tenant in common interest between the two of them.
But how about if it was separate? Well, no, if it was separate property,
if
she wouldn't have been on the title anyway. But she lived there.
Or let's just say it was let's say it was transferred to the wife, and the husband no longer has title. Now the wife sells it a year later, so they both have lived in it 2 out of the last 5 years, right? But it's only the wife's property now, so it only shows up on her tax return.
So she would only get the $250.
She only get $250. Mm-hmm.
Got it.
So I guess if you're in a divorce situation and this applies to you, you just want to be careful how you do the property settlement.
How about this? Let's say it's separate property. I inherited a home.
Okay.
And I live in the home, and this is 20 years ago.
Okay.
I get married, but I keep it in a separate property trust or something like that, right?
Yeah.
And so, but wife moves in, and then we live there for 10 years. I'm on title of it. She's not on title, but she's lived there. We're married.
Yes.
I sell it. What do I get?
Yeah, I think you get the $250 only because your wife was not a owner. Ownership and
I'm going to take that one to audit.
Occupancy.
I'm going to audit.
You're going to question that one?
Yeah.
All right, well, stay tuned. We'll get I think that's the answer.
All right, well, there you go, Big Al. All right, here's another one for you. Then we got to take a break.
Okay.
How do I become financially strong and independent at 22 years old?
Oh, wow. I like that.
I have a full-time job. He's making $10,800 annually before taxes.
Okay.
I'm 22 years old, single, have no kids.
Okay.
I have no established credit. I need to buy my first car and get an apartment or trailer before 2016 ends. Where should I start investing with $1,000? Should I put it in savings or look into other options?
Good question. Well, you've got competing goals there, bud. I mean, if you want to become wealthy, then you don't want to be buying cars and things like that. On the other hand, you need a place to live and you need a car to drive in.
So Al's advice is walk.
Get a bicycle.
A bicycle?
And live in a trailer.
Yes. You know what? Here's a really good option for this individual. I just did a video on being financially strong in your 20s and 30s.
Yes.
So you can go to purefinancial.com. It's a 7-minute video, I believe, or is it 8? I think it's 7. Maybe I said 6 last time and I got in trouble because it's actually 7. Whatever.
Okay.
It's under 10 minutes.
Okay.
I should be clean. It's an under 10-minute video. Go to purefinancial.com. It's really quick. It just tells you everything that you basically need to know if you're in your 20s and 30s to become financially independent. Because that's the goal, right? We got to get them while they're young.
We do, and I think if you can start saving, and believe it or not, start saving for retirement, try to set aside 15%. I'll give you a little teaser. 15% of your income at any age, and just keep doing that all throughout your career. You're going to have plenty of money when you retire.
I mean, anyone who's recently retired, they know this, right? And most people that are recently retired are retiring soon. Unfortunately, now they have 3 significant challenges facing them today. Truth be known, you probably haven't saved nearly enough for retirement, and you don't have enough to last you the next 25, 30, or even 40 years. So you got to get serious about saving right now. You have no retirement plan. Right now, your plan is nothing more than a bunch of, scattered statements. There's no plan or strategy surrounding healthcare, taxes, Social Security, or how really your investments are going to work altogether. And if you're truly honest with yourself, you probably have more questions than you have answers. And finally, 99% of what you know about retirement is dead. It's the equivalent of like an 8-track tape player. You need new solutions that are going to stand up in today's challenging environment, like record low interest rates, increasing longevity, skyrocketing healthcare and medical expenses, unprecedented stock market volatility in a country with $18-19 trillion in debt. Do I want to keep going here? Do you want me to? You may no longer rely on company pensions or government for your retirement. You're totally on your own.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out. Thanks for tuning in. Going to 7? Yeah, sounds good to me. We're talking financial planning today.
Yeah, we are. You got some questions for me?
Yes, I do. So Investopedia, they send me these questions once a week. And so what we do is read them on the air. So here's another one for you, buddy.
Okay.
All right. So my mother-in-law is in her 70s.
Okay.
She will live comfortably on her monthly Social Security check and has 1/3 of her assets in the bank. She will come into the other 2/3 when she sells her home. What do you suggest she does with the money she gets from the sale? Should she get an inflation hedge and some appreciation while being conservative at her age? So, should she get an inflation hedge and some appreciation while being conservative at her age? Well, so this sounds like you kind of want your cake and eat it too.
Yeah, you want a little of both, right?
Let's get high returns, no risk.
Yeah, so mother-in-law
Doesn't exist.
Mother-in-law in her 70s, basically living off Social Security. So,
But how's she living now, I wonder? Because
not on high on the hog, I'll tell you that.
well, she's living comfortably on her monthly Social Security check.
That's what it says.
Okay, so she's fine. And then 1/3 of her assets are in the bank and the other 2/3 are in the home. So she's going to sell the home. So she's got 1/3 of her assets safe in cash, probably, right? So the other 2/3 she needs to invest, but she doesn't necessarily need the money to live off of.
Right.
She's in her 70s, but there could be a long-term care issue. So does she have long-term care insurance and all of that stuff? Right?
Yeah, a lot of questions. So, I mean, she could easily live to 95. I mean, we don't know, 70s, or early 70s, low 70s, I think it said.
It said mother-in-law is in her 70s.
70s, yeah. Okay. So let's say she's 75. So she could live another 20
years.
20 years,
sure.
Right? And so as a consequence, do you really want to be 100% safe and get almost no return? The answer is no. That's 20 years. And so, yes, you need some kind of inflation hedge. But in terms of how much you would actually have an inflation hedge, and that would be kind of in the market, versus something that doesn't have an inflation hedge, like cash or like some bonds and things like that. Although some bonds do have an inflation hedge, Treasury inflated protected securities, for example. But yeah, you probably want to have some in the market and some safety.
But these questions aren't possible to answer.
Well, there's too many questions to answer. So for example, here's a couple different paths.
Right.
One is if she's never going to need the money. Let's just pretend she's got long-term care insurance and she's good, right? Living off Social Security, high in the hog on Social Security.
Killing it.
So then this money is really going to go to the kids. So you might as well be slightly more aggressive than you would normally be for her because she doesn't need it.
Sure. What's the goal for the money?
Right. Now, the truth is that probably isn't true because you never know when you might need the money for some kind of medical event or even if you have long-term care insurance, maybe you got a 2, 3, 4-year policy. What if you need it for 10 years? Right, so you have to be mindful of that. So you don't just want to be crazy.
And I think the answer, in real simple terms, is really to take a look at what the money's for, and then take a look at what the income need is for the portfolio, if there is one, and then find a target rate of return, and then build a portfolio with the least amount of risk to achieve that target rate of return. right? Is it 3%? Is it 6%? Is it 5% or something like that?
Right.
Right. It's not like, and I hear this on other radio shows. Well, you should have a 60-40 split and go into the Vanguard fund and go into this fund or whatever. I mean, that's ridiculous how why they would put that out there, because I think that's irresponsible.
Yeah,
in a
it
sense.
is irresponsible because there's too many unknowns.
There's way too many unknowns. So, yeah, you probably want to take a look and see, well, what's the money for? How long do you, good health, bad health? What's the long-term care situation? Take a look at, And if you don't need the money, why take on the risk? Right? So you just build something fairly conservative. But if it's not for her, like Al said, if it's for the kids, I mean, we have clients in their 80s, but they want to leverage the money for their grandchildren.
That's right, for college.
Yeah, so it's like, well, here,
even...
it's not for me, it's for the grandchildren. So my grandchildren's 5 years old. So, yes, those are inequities. But if they're looking at creating a retirement income, of course, you would have a different strategy, in regards to what they're trying to accomplish with the money. I think a lot of times, again, people put the investment in front of the planning. And then that's where most people fall into problems, because they have zero confidence in their investment strategy because they don't know what the money should be doing for them.
Yeah,
they just look at the return. That's their gauge.
You're right. So you take a step back, right? You try to figure out what the money's for. What are your goals with the money? And it's probably a bunch of things. I mean, some of it's for contingency. What if I have a long-term care event? Some of it might be for the kids or the grandkids. And it's like, all right, now once you know that, and once you can figure out a tax plan to reduce taxes, then it's like, all right, what rate of return do I need to make to meet my goals? Goals-based investing. That's really how everyone should be investing, and so few people do. So many people go right to the investment and go, what's the return?
Yeah. I want the highest return with no risk.
Yeah.
Okay, well then you're going to get sold a stupid product, right, that really doesn't exist.
And you're probably not going to be happy with
You're not going to be happy with it, right. All right, I got another one, quick one for you, buddy.
Okay.
All right, my father sold a piece of property that he inherited in order to pay for assisted living expenses.
Okay.
All right. He passed away the year of the sale. His income was less than $15,000. Does his estate pay capital gains on the property, which is $144,000 on the date of the inheritance?
Oh, interesting question. So does it say, did it sell before he died or after he died?
Let's see, my father sold a piece of property that he inherited in order to pay for assisted living expenses.
Okay.
So his dad sold some property.
Sure.
Then he passed away the year after the sale.
Oh, the year after. Got it. Okay.
His income was less than $15,000.
Okay.
Does his estate pay capital gains on the property, which is $144,000 in value?
Well, in a roundabout way, yes, but it gets paid on his return, on his final return. I'm assuming because of the question, he hasn't filed the return for last year. And so, yeah, that has to get paid on that tax return.
But then you have to take a look here, too. And we'll talk a little bit more about this. We're kind of on a hard break here. But, right, he inherited, so you could get a step up in basis. Then he sold it. There might be very little tax in a sense.
It depends when he inherited, though.
But, well, I suppose it says the gains here, $144,000. So
Yeah.
who pays the tax? Does it go on which return? So that's what we're going to answer when we get back. If you want more information about us, go to purefinancial.com. Purefinancial.com. We'll be back in just a second. Show's called Your Money, Your Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He's a CPA. Thanks for tuning in. Join us on all of our social media. We got YouTube, we got Twitter, we got Facebook, and all that other fun stuff. Or just go to iTunes.
Yeah,
Your Money, Your Wealth.
Get our podcast.
Get the podcast right to your device, smart device,
and
weekly.
You can go to our website and watch our TV show if you haven't seen it. Purefinancial.com, P-U-R-E, financial.com.
Yeah, I heard a little Emmy buzz around the office.
Well, you know, the last week we were higher rated than any other show in our time slot. How about that?
Yeah, I think 7 people watched because we're at like 3:30 in the morning.
we had the corner of the market.
Yep, Emmy buzz going around. This weekend. You know what I'm doing now? Shopping for a new tux.
Pick me up one too, and then I'll return it if we don't get it.
So, all right. Before the break, we were talking about this question we got So let me repeat the question to you, Al.
Okay.
All right. So this child is curious about the taxes about his father transaction. So his father sold a piece of property that he inherited in order to pay for assisted living.
Okay.
So he inherited a property, sold it, and then that went to assisted living expenses.
Okay.
He passed away the year after. He passed away the year of the sale.
Okay.
Sorry.
Got it.
He passed away the year of the sale. His income was less than $15,000. Does his estate pay capital gains on the property, which gain $144 in value from the date of inheritance?
Oh, okay. Well, you did a better job reading it this time.
Yeah.
So anyway, it depends upon whether it actually sold before his death or after his death, because that's going to depend.
He passed away the year
of
the sale.
Right. We don't know whether the
He
sale.
sold it, though,
Yeah.
because he had to pay for assisted living. Then he died in the assisted living facility.
Sure, but we still doesn't say for sure. I mean, we can make
the
the
CPA needs everything so exact. It's so annoying.
10 years of this.
So annoying.
You're pulling your hair
Well, I
out.
don't know. It's not written down. It's not black and white. Can't do it.
I'm still going to answer it the way I want to.
All right, whatever you want to
If
do.
he sold it before he passed, it gets paid for on his final individual tax return. And of course, the tax itself will be paid by his estate because he's
Dead.
He's dead. I mean, the money went, but it's going to be paid on his final tax return. And I agree with you, Joe. That's probably more likely. But on the other hand, what if he sold the property to pay for the assisted living in anticipation of paying the assisted living, and he died before it even sold? But then it ended up selling after he passed. Then it gets
stepped up.
Then it gets a step up in basis
To the heirs because he's dead. Then
Right.
it's sold, and then I guess the
it's
estate
paid-
sold it.
Yeah, it's paid for by the estate. The estate actually gets a federal ID number as an estate and trust, and that capital gain is taxed on that return. But there's no gain or loss because there's a step up in basis.
So, all right, you're my beneficiary. I'm selling my house, and I'm in escrow. The signing is tomorrow.
Okay.
I die today,
Okay.
and it has a $1 million gain.
Sure.
You don't pay any tax.
No, because it got a step up the moment you died.
So even though, let's say I died right at the table signing the papers.
Because I poisoned you.
Yeah, right, exactly.
Perfect. Some quick action poison.
Yeah, right. All right.
Then it's a step up. It's the property transferred to the estate.
So I guess before he distributes the estate, he needs to make sure that he files that return and pays the taxes.
Correct.
And so on his return,
That's right.
so what it's going to show is a $144,000 capital gain.
Yeah.
He's got $15,000 of income. That $15,000 of income is going to get wiped out with his deduction, probably like his standard deduction exemption, just about. And so there'll probably be close to $40,000 of the $144 tax free. So they'll pay capital gains on $100,000. Depends on where he lives, 25%. So $25,000. So
Right.
make sure that you cut a check to the IRS roughly of $25,000. Then you distribute the $100,000 to the heirs.
That's accurate. So in that particular example, had they been able to borrow a little bit of money, right, before he passed, then when the property is sold, that loan gets paid off, and there are no taxes because of the step up in basis.
I think he's confused here too with this question.
Could be.
Because if he sold the place, I mean, so he's, I guess, unless the guy was in an assisted living for how many years? I mean, $144,000 gain?
Yeah.
But
well,
he inherited it. Did he live in the house? Because if he lived in the house,
yeah, then we're back to the
2
121
out of the last
exclusion.
5 years,
Yes.
right?
Right.
It doesn't matter where it came from if you purchased it or you inherited it. If he'd inherited the house 2 out of the last 5 years and lived in it, then
Sure.
sold it, then he would be able to exclude the $250,000 of gain here.
Yeah, and then there would be no tax, even if it's sold prior to his passing. You're right.
Do I qualify for a backdoor Roth IRA? Here we go again.
Okay. Didn't we have this question last week?
I own a 403B,
Okay.
a 457,
Okay.
and a DCP account.
Okay.
Do these count towards the pro-rata rule?
They do not. How about that, right? Because those are ERISA-type plans. They do not count for the
Well,
pro-rata
they're
rule.
not ERISA type plans, but go ahead.
Well, forget what I said then. They are
Employer sponsored plans.
they are non-IRA plans. How about
Yes,
that?
there you go.
Am I correct on that? Let's man, working with a CFP, just details. Anyway, so The pro-rata rule means that if your income is too high, you can't do a normal Roth contribution. And what are those limits? It's $117,000 to $134,000 for a single. 132. Yeah, you're right. 132 for a single taxpayer. That's the phase-out period.
Yeah, 184 to 194 for married. 116 to 132 for single.
Yeah, so if you're below those numbers, you can do $5,500 each year that you have earned income or your spouse has earned income. Or if you're over 50, it's $6,500. But if your income exceeds those, then you cannot do a Roth contribution, but you can do a non-deductible IRA. Even if you're maxing out your 403B and 457, you can still do a non-deductible IRA. And then you got this money in the IRA, you can then turn around and convert that. And because you did not get a tax deduction, you don't have to pay any tax on the conversion. Hence, it's kind of like a Roth contribution, but they call it a backdoor because you went in the backdoor, you did a regular IRA, non-deductible, and you converted that. The problem with that is if you have other IRAs, then you've got to do what's called the proration or aggregation rule.
Right, that's what he was referring to. He's like, okay, well, here, I have these other retirement accounts. Do I have to follow the pro-rata aggregation rules?
And you don't. So the pro-rata rules means if you had $100,000 of IRA already with where you got the tax deduction, let's just do that as an example, and you do another $5,000 into a non-deductible IRA, so it's only $5,000 divided by 105. You have to add up all your IRAs together, and that's something a little bit less than 5% of that Roth conversion is tax-free. The rest is fully taxable. But interestingly enough, the 403B, the 457, the DCP, the 401A, the 401K, all of those are non-IRAs, so they don't count towards this aggregation rule.
I mean, you got to try to imagine your retirement game plan, all right, was no longer just about a number or just about your investments. Imagine if you could fill in all the gaps and you could have all of these answers, to this rock-solid game plan that covered everything from A to Z. Imagine what kind of confidence that would bring.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I am with Alan Clopine. He's a CPA. Thanks for tuning in. Hopefully you're enjoying the show this far. Big Al and I always enjoy doing it for you. You can go to iTunes and go to Your Money, Your Wealth if you want to get our podcast. Or you can go to purefinancial.com. P-U-R-E, purefinancial.com. Got a couple more emails for you, big guy.
Great. What do you got?
All right. How should I manage my extraordinary tax year?
Oh, okay. I like that.
All right. So here we go. And this is a long one. I've been laid off.
Oh, boy.
And retiring earlier than planned.
Okay.
I will receive 1 year's salary as severance. Okay. Not deferrable to 2017.
Got it.
And I am told I must take my 401k as an in-kind distribution this year in total in order to have favorable treatment of NUA portion.
Wow, this is getting interesting.
However, I'm also told that while I can defer taxation on capital gains tax on the appreciated growth, I must currently pay ordinary income tax on the basis amount, which will approach about $100,000.
Okay.
Is this guidance accurate? Can I do anything to manage taxes for this year? I understand income averaging was repealed in 1986 and isn't returning.
Right, that is true. Oh, okay, that's a good question. Laid off, 1 year of severance, all paid in this year, and it doesn't say when he or she got laid off, but let's assume half year. We don't know anything else, right?
That's all we know. That's all we got.
So you have more than a year's salary within a year, and this net unrealized appreciation. So what this is when you have company stock inside of your 401k, in the year that you retire, you can pull your company stock out of the account. You can put it into your brokerage account. Whatever you paid for it, whatever the cost basis is, then you have to pay ordinary income tax on that. But the rest of the gain, you don't pay any tax on until you actually sell that stock. And when you do sell it, it's long-term capital gain, which for most people is a lot cheaper rate. So whether that's a good idea or not is completely dependent upon what the value of the stock is. So in this case, is it he or she, or doesn't say?
Doesn't say.
Okay, so I'll just say
nomad. He, she.
The he, she. This individual said that they have implied that they have company stock of $100,000 What'd you say?
Its name's Pat.
Pat. So it could go either way.
Yeah.
It doesn't help. Okay, Pat.
Do you remember that Saturday Night Live?
Live on Pat?
Oh, God. I loved that one.
Yeah, I don't remember that.
You don't remember Pat from Saturday Night Live?
No. Who did it?
I don't know. You couldn't tell. But you couldn't tell if it was a boy or a girl.
Oh, got it.
And then they kept on asking Pat questions to see.
To try to figure it out?
Yeah.
Oh, that's kind of funny.
So good.
Anyway, so you got this company stock. It costs $100,000. Yes, if you do this NUA, which is an option, by the way, it's not required. It's an
I mean,
option.
you don't have to do the NUA that year. You can push it off into 2018.
Yeah, well, unless they're 2017.
Or 2017.
Yeah, unless Pat was was implying that he or she had to do it in 2016. That's how I read that.
Right, but I think he was getting that advice that he had to do the net unrealized appreciation in the year he separates from service, but I don't think that's true because I've done net unrealized appreciation
Like the
transactions
following year.
several years later.
Yeah, I would agree with
I mean, just recently, I did one for an individual at SDG&E, worked there for, 40 years or something like that, kept the money in the plan, came in, and then significant gains, of course, with SDG&E. He's worked there for 40 years.
Right.
And we were able to do the net unrealized appreciation, and it was several years after separated.
Right.
But maybe the plan doc on certain plan documents. So, I mean, this is not tax law. This is certain plans. And here's the funny thing, too. With plan documentation, so let's say the company creates the plan within the 401k, and they're saying, okay, we're going to allow this, not allow this, and so on and so forth. So the company creates that 401k plan document. That supersedes the IRS, which is crazy to me. But whatever the plan doc says is the law, even though the law might say something else. Like the Pension Protection Act of 2006 came about, and then that had some different changes in the overall way that, like Roth conversions, for instance. You don't necessarily have to go to an IRA anymore to go directly to a Roth. You can go from a qualified plan to a Roth, in-service distributions,
Sure.
IRA rollovers, and things like that. There's certain things that the law allows individuals to do, but if that plan doc is more stringent, then you have to follow the plan doc. Or at death, for instance. Like, still some plan docs will say, no, once you die, this money has to be distributed out within 5 years. They're still back on pre-2000 rules. Right? So they haven't updated the plan doc for some reason, so you have to follow those plan document rules. So with this, if he was going to do the net unrealized appreciation, well, I guess we'll just assume he has to do it in 2016.
Okay. But I think that's good advice, Joe. I think it's I think that's the first thing you check. Can you do this?
Oh my God!
Your whole thing almost fell over.
Do you see those cat-like reflexes?
It was pretty good. Gosh, we got this music stand today, right?
Oh,
and so yours almost fell right over.
Yes.
You got so excited.
I did.
That was question.
Really...
I complimented you.
Dude, I thought I was going to lose
Anyway,
it.
I thought that was good advice, which is first thing you do, Pat, is Pat. you gotta see if you can do this in-service withdrawal in 2017.
Yeah, you do the net unrealized appreciation in 2017.
But you first got to see, is it worth it? Like if your stock is worth $110,000, you only have 10.
Yeah, right.
You only have 10,000 to gain. This is a stupid idea.
Yeah, right.
But if the stock is worth $1 million
bucks,
you got 900,000. You can switch to capital gains from ordinary income. I'm all over that, but try to do it next year.
Right. So I guess that's a really good point, Al. Is that all right? So here's this net unrealized appreciation again, real quick. Is that all right? So this individual has severance that he has to pay this year, and then he was told, or she was told, that they have to take out the net unrealized appreciation that year. Okay, well, $100,000 is the basis. So you have to look at, well, how much appreciation is it? Because if I'm going to pay ordinary income tax on $100,000, that stock better be worth at least, $500,000?
Yeah, a lot more.
A lot more. But you don't also have to do this. You don't have to do the whole thing.
Right.
You can look at your tax bracket, just like what we talk about with Roth conversions. Is like, all right, well, here, you want to look at what line 43 is, what tax bracket that you're in, and then you can do partial net unrealized appreciation too to maximize whatever bracket that you think is appropriate for you. So there's so many different combinations of strategy that this individual should look at. I believe that they might be getting bad advice front of saying you have to do that this year. I would dig in a little bit deeper. But if you absolutely have to, you have to take a look at what the appreciation is of that stock. And is it worth it to do the full 100,000, or is it worth it to do something else, or is it worth it to do it at all?
Correct.
I mean, you don't necessarily want to do it if there's not a large gain, because it's pointless.
Yeah, and Joe, let's say that it can be deferred to 2017. Then you got to look at your salary, your 1-year severance, plus your other salary that you earned. You got to do a little tax projection, figure out what bracket you're in. You probably don't have enough paid in for California, so you want to prepay that by year end for the tax deduction, unless you're subject to alternative minimum tax. Then it's a waste. You want to look at charitable strategies. There's all kinds of stuff. You got to do that before year end. And Joe, it is interesting when we get cases like this, because it all really boils down to taxes don't stop when your paycheck does. They keep coming. Unfortunately, tapping your retirement nest egg comes with all sorts of new rules, but also opportunities if you understand the strategies. But as you near retirement, tax planning becomes more important than ever before. But you must use a forward-thinking tax strategy if you want to get this right. If you're serious about saving taxes in retirement, you got to line this up. You got to look at a bunch of years in the future in retirement to figure out how to pay less taxes.